Everyone's time and get started because we are going to stop it at 3 o'clock to let everyone get to whatever they need to get to next. But welcome. Everyone here is a member of NYRS. I'm here, Julie Brannan, along with my co-chair of the NYRS Executive Committee, Nicole Beauchamp, and there are other members of the Executive Committee also on this Zoom. And we had the idea that it might be great to have some real data experts come in and talk to us about the current state of the market. You know, we just received the most recent quarterly reports, and no one is more on top of what's going on in the current state of the market than NYRS members. So just a little housekeeping. If you have questions, if you could please put them in the chat. The other thing I will say is that we are going to watch the time, and so we'll have fun till 3, and then we'll wrap it up. So Nikki, would you like to introduce our guests?
Absolutely. Happy Tuesday, everybody. I have the honor of introducing 3 people who I like and respect very much and consider friends, and they almost need no introduction. You have Jonathan Miller of Miller Samuel, Noah Rosenblatt from Urban Digs, and Kael Goodman from Market Proof. Thank you, gentlemen, for doing this with us. We're so excited.
Thanks, Nikki.
Yeah, glad to be here.
Thanks for having us, Nikki.
So I guess we should probably start out talking about, I don't know, should we talk about the housing market maybe? I was thinking, when you think about the housing market right now, whether it's New York or anywhere else, there's a couple of key points. One is that new inventory coming into the market is actually falling. And that in the last couple of months, after slipping from pandemic era peaks, we're actually seeing nationally prices rise again. And yet we have mortgage rates that are well over 7%. And what does this mean? So I think that's probably where we'll start. I don't know what you guys, maybe one of you can chime in.
Can we start with the inventory piece, Jonathan?
Sure.
I'm curious, just in your reports, what you're seeing in New York versus other regions.
Yeah, so I cover about 50 different U.S. housing markets, including the New York metro area for Douglas Elliman. And the one thing that we're seeing, probably more than we're seeing in New York, is new inventory coming into the market is falling, and aggregate inventory, total cumulative inventory that, if something went to contract in May and it hasn't closed, but you still count it as a contract, we are seeing, we've seen a seasonal uptick. But obviously, volume is way off of sort of peak pandemic numbers. And I think that's the hardest thing to sort of everybody get their arms around is, how do prices at least remain flat or rise with sales being down, in many markets, 40, 50%. But remember, they were inflated by 30%. How do we rationalize that right now? Why is that happening? And are we expecting the end of days, or what? What's going on?
Yeah, I've been talking about this a lot with Johnny and on some of our updates, and it feels like it's a very bifurcated market, guys. Almost again, there's no chart to measure this, right? So you're trying to rationalize, why is this all happening? Why is price action rising when deal volume is falling? And it feels like you got 2 kinds of buyers. You got buyers that are willing to bid on these types of properties, and then buyers that are heavily penalizing these types of properties. And the only thing I can come up with is if the property needs intervention in any way, right? Estate condition properties are very tough sells right now. If the property has a high maintenance issue in the building, if the property has temporary assessments or scaffolding or display issues that are going on right now in the building that presents poorly. If that property has something across the street that's going to get built and there's a view that might change that was there 5-6 years ago and now it's going to change, these are being penalized very heavily. And I think that's what's going on here. I think buyers are bidding up for lack of a better word, like turnkey premium products.
Yeah. The other bifurcation is, and something we talked about it last week in our report, is if you just look at cash versus finance purchases, overall purchases, let's say, just pick even numbers, year over year, down about 40%. And then if we look at finance purchasers, which are 1/3 of the Manhattan market, those purchases are down 55%. And then if you look at cash buyers, they're down 28, 29%, the high 20s. So what you're seeing is, a larger share of the decline is associated with mortgages. Mortgage purchases, the idea that cash buyers aren't affected by this is absolutely incorrect. But it does reduce, it clearly has reduced their activity in the market, but at a much lower rate of decline than what we saw on the finance side. So, and in fact, the cash buyers were in the second quarter of this year were the highest share on record at about 2/3 of the transactions or the closings in the quarter, which I think says a lot.
Right, and the delta between when it peaked in terms of the percentage of finance buyers to now is what, 30%, or is it more, Jonathan?
I'm not sure.
If we have 2/3 right now are cash buyers,
Yeah.
what was at the other end?
Oh, so it was just like in the mid 40s would be the, but I only have about 9 years of data. I don't have but it's it basically, the long-term average is like just over 50%. And now it's, and incidentally, we're seeing the same sort of phenomenon in Miami, which is a heavily cash market for different reasons, mainly because banks are much more afraid of Miami than they are of Manhattan.
In the new construction area, just to kind of weave this in here a little bit, the cash buyers are even higher as a percentage. But also, one thing that we've talked about at Markproof a lot over the last couple of years is the inventory of new construction in Manhattan and across New York City. And if that unsold inventory peaked at, say, 15,000 units in 2019, 2020, at this point, we're down to kind of under 12,000 units and maybe around 3 years of inventory.
Yeah.
And so it's a big change. And, just kind of the other thing to bring into this, again, another big difference in New York and other markets is, whereas new construction has really heated up in other markets in New York, it definitely has not. In fact, the kind of pipeline of new stuff coming in the market is at best tepid.
Yeah, and
very, very little coming.
Yeah.
Kael, I mean, I think we talked about this like a year ago, right? Or a year and a half ago when the pandemic was going. And it was crazy at the time because we did have we didn't have a lack of inventory problem back then. We had the inventory come on. And it was like, these dynamics are in place to set up a very tight inventory market in 24 and 25. And here we are, it goes so quick.
Yeah.
In 23. Yeah.
And you think about, sorry, Jonathan, and you think about the decision to build, right? How many years in advance is that made versus getting to market? And you're looking at activity going on in the last 6 months, 9 months, and you look ahead, you're like, holy shit. Sorry. Yeah. But it's like what's data
talk. It's okay.
Yeah. We'll edit that piece out in the recording.
But it's gonna set up a problem. It's gonna set up a problem, and it's
down the road.
Yeah.
Yeah. So we've been projecting 6 months from now, 12 months from now, how much new inventory is there going to be? And with so little coming on, and the new inventory sales being, relatively robust. I mean, we've been outpacing. We tracked the 2015 to 2019 period as a kind of benchmark period, so that we aren't comparing to the, the overheated years. And all year we've been outpacing those numbers virtually every single week of the year until the last couple of weeks, which I think are due to more international travel. People are, moving all around the world finally. And so now we're starting to see we're dropping below the benchmark, but there's no reason to think so far that the new development sales won't continue to outpace where we were before, which means that there's a preference for kind of cash buyers, new development, new stuff, but there just isn't going to be that much to go around. And for the buildings that are seeing the most robust sales, they're in a pretty good spot right now. So if we look out a year or two from now, to Noah's point, where are we going to be? We are seeing a few developers start to plan out new projects, but again, it's very beginning of the cycle. They've got to get financing in place.
That's actually the biggest problem, because with the rise in rates, the other thing that happened is that credit conditions in general really tightened significantly. Like the one thing that was different about I call it the pandemic housing boom, was that banks never lost their mind, and credit conditions compared to pre-housing bubble back 3 decades, credit conditions were generally about 80 to 90% of with 100 being normal, were tighter than normal. Now that we've gone into this sort of pretty sharp rate increase era, credit conditions are actually even tighter, and so lenders are back to sort of looking for reasons not to lend, which is one of the reasons why we're seeing cash buyers. I don't want to overstate that, because the whole world can't pay cash, but it certainly has been a reason why we're seeing record market share of cash buyers.
Yeah, and mortgage rates, I think, are nearing their highs for this cycle right now. I think they're is it near 7% now at this point?
It's over like 7.25.
Yeah, so we're getting to that point, and we're starting to get. I mean, guys, you have to think about this monetary policy with the Fed and their rate hikes. First off, this has been the most aggressive rate hike campaign in the shortest amount of time since the 70s. So that's since Volcker. So that's that. Number two, I don't know the exact time, but it takes a while for these rate cuts to funnel through the economic system and have an impact. So they're still unsure if they're in restrictive territory or not. They're talking about another hike.
Right. I think actually, so they skipped the last hike, right? But that was a skip, not a pause, even though they use the word pause. But pause to me means you stop for a while, right? And really, I think what it was is that they skipped the last one because they didn't want to do a 25 basis, quarter point increase. They wanted to do less than that. So they said, well, let's just take the next two and do one and not do one. And so now what's coming into the conversation is maybe another one or two. And the reason why it's very unrealistic to think of any kind of rate cut in 2023 is unemployment's at 3.5%. That's
it's ridiculous. It's ridiculous. We've been talking about this for months on our Macro Monday show. The whole Fed Fund futures. Sorry to get a little animated here. The whole Fed Fund futures was predicting a rate cut in September. Of this year.
Yeah.
5. It's like, look at the labor market, look at core inflation, look at the financial stress and the financial conditions index, look at the credit market. Like, John, there's no crazy credit event or credit spread. There's no crazy credit stress going on. How are they going to cut rates?
Right. And so just to take sort of a step back and say, well, the reason why they're raising rates, they're basically taking, as I like to say, a baseball bat and trying to damage the economy, just beat it up. And we saw that with the banking crisis a couple of months ago. is because it's too strong. And so, you know, while mortgage rates are certainly, as we see, important to the housing market, significantly important, but also too, you know, when you also have a very robust economy, you have, you know, wages are higher than pre-pandemic, and you've got, you know, incredibly low unemployment, which are all conducive to home buying. It's just that, you know, the way I look at it is the best thing that, you know, instead of thinking about like a rate cut, I think that's sort of a folly of, you know, waste of time. I think over the next year, you should be paying very close attention to whether or not, you know, whether the Fed actually pauses, because I think after, you know, if we go 2, 3, 4, 5 months without rate increase, consumers have more time to put their arms around it, be more willing to be creative, and also more time will have passed where people are less wedded to their 3% mortgage rate because they just had twins or whatever sort of family change is in store. But it's
Hey, Jonathan.
Yeah.
They right now the futures market, which has been wrong consistently, has one hike at the next meeting and then a pause all the way to May of next year. May of next year will be the first cut.
Yeah,
So how many
I
months
would be
is that?
shocked if they did that. I think that
Well, the
they're,
only way they don't do that and they cut sooner is if they break something.
yeah, well, we saw that with the banking crisis, you know,
We saw a little preview with that with the banking
little
crisis.
preview, and thankfully it didn't spread.
There's a
Right.
one keyword that hasn't been mentioned yet. Recession.
Recession.
We
Well,
haven't said-
we've been mentioning recession for 2 years, that it's like, it's the 6 months from now. Every economist, you know, it's like, we have a recession in store, you know, in the next 6 months. And that's been the narrative for 2
it's
years.
just over the horizon.
The worst
Yeah.
kept secret. Like it's the most
Yeah.
widely anticipated recession, you know. It's crazy. It's like,
Yeah.
I mean, is the Fed actually going to navigate a soft landing here? I mean,
I
it'll be a
don't know.
first, you know, but it's crazy.
Well, I like that it's time to bring out a economist joke. The difference between a micro and a macro economist is microeconomists are wrong about specific things and macroeconomists are wrong about things in general. So anyway.
Yeah, it might be rocky. I mean, but you know what? Manhattan real estate, just to circle it all back to that. It's weird. It's weird because when you look at volume, and usually you look at deal volume and liquidity and see whether or not it's a good season or a bad season, right? We kind of had like a little bit of a lackluster season. We had a good March, we had a good May, and that was about it, right? But when we did this new chart, which we called success, a listing success chart. And what we did is we tried to define if you listed like a while, January, February, March, even before that, what is the chance that you are actually in contract, that you succeeded and you closed or got a contract signed? And what we found was really, really interesting, especially relative to 1 and 2 years ago when the market was vastly better and more frothy and more active. What we found is that the success rate is notably lower, and it started going lower in May of last year, and it just kept going low, from 60% success all the way down to about 44% to 45% success today. So there's a big gap now, saying what it basically is telling you is that it's a much more challenging market than just looking at one number of deal volume and liquidity. Look at liquidity, like, all right, we're kind of neutral or a little below where we should be, but it's not bad. You know, then you look at this chart and you're like, holy crap, it looks like it's a lot harder to sell in today's market than it was 1 or 2 years ago. And it may be because those things we talked about in the beginning.
Yeah, I think also, like, we can see this in our appraisal practice that you know, we're back to that sort of that period where it's very difficult for sellers to capitulate to pricing in the new market. And so, you know, I always, I'm just trying to keep this going. I said in the beginning of this year that 2023 was the year of disappointment. And it's because buyers aren't going to get their sellers aren't going to get their 2021 price, and buyers aren't going to get a significant discount. And I still think that holds. I haven't trademarked that yet, but I do think it still makes sense.
But that's a balanced market. I mean, both buyer and seller are basically
Everybody's-
succumbing a little bit.
Right, everybody's unhappy. So
Well, what year do they need to get back to? How far back do they need to go to meet?
yeah,
That's why we keep looking at.
You mean
the-
in
Well, that's why we look at,
2019, we're probably
right. That's why we look at the benchmark of before that period.
yeah.
we're probably around 2019. I mean, who knows? We're probably falling right now.
Yeah. So, the other kind of, I mean, there's another big elephant in the room is, what's happening in the office market and how that might affect New York City at large. Let me just tee that up as a question for you guys. If either of you have any thoughts at that, does it bleed over? Is it a separate thing? What are we talking about here? What's the prognosis for New York City as a whole? Any thoughts?
Yeah, I do. I mean, that's the big conundrum, because you have the Castle data showing, office occupancy, except for 1 week, can't get above 50%. Remember, those are card swipes. And also remember that the year ago data was 100%, or the pre-pandemic was 100%, and occupancy was not 100% in 2019. So when you say it's 49%, it's really like 45 or 43% occupancy based on card swipe data. That being said, residential is seeing record rental prices, clearly seeing a drop in sales activity. I think commercial, the problem with commercial plays out 5 to 10 years. When we were looking for new space, saw all kinds of evidence of landlords unable to capitulate to market conditions because they wouldn't be able to make their finance payments. I mean, that literally was the problem. When you have sort of office leasing, in my view, has fallen 25 to 50%. And that's maybe a little conservative. And I don't think, and a big part of it is that, I mean, on the negative side, right, you have this playing out. You have landlords that have tenants that are locked into deals for 5 or 10 more years that they paid rent based on pre-pandemic levels. So they're not feeling the direct pain. And then you have others that are feeling it. And I think this sort of drags out in slow motion. It's like some kind of water torture for the landlords.
So on the residential side, you have a kind of, to Noah's point about the success rate dropping.
Yeah.
And then the commercial side, you have this spread between the bid and the ask. And as long as there isn't some event happening, a maturity of a loan or something, that's also kind of in a pause button has been pushed.
Yeah, I think what's going to happen to those landlords is that they're going to lose their bill. You're going to see the office market, a lot of deals move from weak to strong hands, where they're going to be able to lower the rent or, the leasing, the asks. And then you're going to have a whole cohort of population that were priced out of Manhattan that are going to come in. And so I'm very optimistic about that. I just think it plays out for a while. I think the idea of commercial to residential conversion is on the margin, floor plate size, underlying debt, just rehab to convert to see the residential CFO just seems problematic. It doesn't seem like something that's going to happen at scale. Yeah.
No.
Yeah, I mean, Kael, you made a really you made a good point before. I mean, I don't know much about the office market. I know Jonathan mentioned that 50% that we're back up to 50%. I saw that. I know pretty much the stuff that you guys probably hear about, which is Class A seems to be doing okay. B and C is getting pummeled. That kind of a thing. And it makes sense given what's going on with remote work and all that kind of stuff. I don't know. I mean, everyone anticipates that the commercial market's going to cause us. Is it going to be systemic? Is this going to be one of those things, Kael, where we get through it, and it plays out like Jonathan says over years. I think that's going to be the case, and the weak hands go to the strong players, and you got to wait. Some people are not going to capitulate. You mentioned that before.
Yeah.
They're just not. It's a very good point, and you may not have a systemic problem, which means we may not notice all this. We may go through our lives and do our business, and you're going to hear about this guy over here and this guy over here, and the bigger guys are going to gobble it all up, and at some point in a couple of years, the occupancy is going to be up to 70% and 80%, and things are going to, class B and C will start to get a bid again.
The prices
will be 50% lower, right? I mean, that's what I think.
Yeah, right. So now we have to go through this thing. So now what Jonathan talks about, now that's the thing, right? So now does this become systemic, right? So does this become a banking thing? Does it become something that actually causes the Fed to change their policy? I don't know. Like, I mean, is what we're experiencing happening everywhere? And is it this whole thing? I don't know. It may not be. It may just, come and go and here and this, and we don't really notice much of it. I don't know.
The pause button has kind of been pushed, right? On both the residential and the commercial side to a degree.
Yeah, but Kael, but here's the thing. The problem is that the last 100 basis points of Fed rate hikes is probably not even funneled through the economic system yet. So it's still as this is what I was saying before, as time goes on and we stay here or go higher, that pain gets deeper and deeper. And for those with their swimming naked and the tide just went out, how long until they, either they get their bathing suit or they don't. So like time runs out on it. That's the only question.
That's kind of my point, is that right now we're in a kind of waiting period until these next few things happen. And so it kind of unrolls slowly right now without a lot happening so far. And based on what happens in terms of monetary policy and the economy overall, we see what happens.
I feel pretty strongly, and that doesn't mean anything, that there's not going to be a contagion of office that spills into the overall economy, unlike the residential market, because the residential market was that was a credit bubble. And housing was a symptom. I don't think there's any credit bubble. Credit is actually been very conservative. No banks lost their mind, or most did, and a few did. And it's just people with a lot of exposure to commercial loans. I just don't think it's going to. I think the average person is going to hardly feel it outside of, what we've been talking. We see here on the news with combating inflation, higher mortgage rates. I just don't think that the office market is going to sort of bleed into everything else like we saw in the residential. It's just a different scenario in my mind.
And let me just say something I think is very, very, very important here. So you got interest rates and you got liquidity, right? With the Fed, right? Interest rates, liquidity, right? So what happened in March? Okay. It's almost like they were trying to push the Fed and force the Fed into like, oh, there's a everyone with some guys I consider I was consider very, very smart guys, traders, are like, the Fed needs to cut 100 basis points now. Otherwise, this is a next grade. And I'm like, are you out of your freaking mind? I'm like, they're gonna hike. And they're like, you're nuts. I'm like, you're nuts. You're nuts.
Yeah.
What'd they do, Kael? They left the interest rates and they'll get a hike it actually. And they provided liquidity to the banks to facilitate all these arrangements. So now if commercial real estate starts to go down, right, and starts to become systemic in a little bit of a way, the Fed's going to see it, and they're going to now provide these liquidity facilities. Get ready, guys. Get ready. In the next 6 to 12 months, or I should say 6 to 24 months, because it's going to take years. Yeah. Watch how many facilities the Fed's going to launch to help ease the banking transition and dealing with this commercial real estate thing, whatever it is, so that it does not become a contagion, like Jonathan just said. And I'm kind of in that camp as well.
Yeah.
Right. And so that's kind of going back to my initial question about how does this impact on the residential side?
Tighter lending standards.
Yeah.
Right. So it can be managed. And we might not see, this might not have to be something that we truly have to be concerned about. Maybe.
Well, if it hits the stock market, it'll hit the bids. But if the stock market doesn't get hit, then the bids will still be there, because like everyone looks at the stock market. But if it does hit the stock market 10% or 15%, then the bids will pause a little bit. That might cause a little problem. But outside of that, it's just going to be the banks are going to pass that all on to the buyers.
Not to go too far astray here, but we do have another thing happening in the stock market that, if we want to talk about that, we have to bring up, which is the impact of AI. Right? Because you have Noah starts laughing. I mean, look at the S&P 500, right? And what percent these few companies now represent. And we're at the beginning of a very important shift in our economy. Steam engines, light bulbs, refrigerators. I mean,
Yeah, Google search, and now we're at this next level for sure.
So that could have a very positive
Yeah.
impact. It could offset some of these negative impacts. So, one of the things that I've been researching is, what is the total potential destructive value on the commercial real estate side versus the positive impact on the technology side.
Right.
Interesting.
Overall, it's not a question that's been answered yet. But if you look at the overall value of the commercial REITs versus the value of these tech companies, it's small by comparison. Very trillions versus billions.
What's fascinating in San Francisco, a lot of the office, but a couple of, not a lot.
I know, I just
office
really
buildings.
off. Yeah.
No, but the commercial office buildings in San Francisco, like their asking price is like 70% less than their supposed value in pre-pandemic, and it all comes down in my mind to just what it comes down to in residential, which is doubling, even though money historically is cheap, it's still much more expensive than it. So that has really crippled commercial lending. And then on top of it, work from home, in my view, isn't going away. It's here, until something supplants it. But in my lifetime, I think it's here. The toothpaste is out of the tube, or whatever the expression is. I don't know how it can go backwards. Yeah. So, instead of 4.5 days, we're going to be, thinking 2.5 to 3 days as an average. And maybe we go up a little bit if we're in a recession, because people want more face time with their boss. But it's not going to go back to where it was. It just fundamentally, maybe by industry, there'll be some that are more collaborative than others, that and then some sort of old school thinking in upper management and some others. But I see this, if it's not permanent, it's decades of changed behavior that impacts, what it's done for the housing market is it's made people think about, working in the city, and, having a second place or a third place. Like, we've seen a lot more of that. Of course, that skews more affluent. But the rationale was, and I had come up with this thing, you've heard me say it before, where, during the pandemic, I called it a co-primary house, where you actually had a second primary house, so that, if there was an issue in Manhattan, you could just go out to another location and work from there and go back and forth or whatever. Like, it's not that specifically, but everybody has done this new math. I mean, I moved a half an hour farther from the city, because I'm not going into the city every day. I was going in 4 days a week, roughly, before the pandemic. Now I'm going in 1 or 2. I'm probably going to end up averaging 2 for the rest of the year, but everybody's thinking has changed, and real estate is reflecting that, good and bad, where there's new opportunities, but there's also things that were tried and true are gone.
Yeah.
Noah?
Kael, well, on the AI thing, so I have a different perspective with AI, because I was a day trader right when the .com thing came up. So I witnessed firsthand the craziness of how that whole thing played out and then what happened afterwards. Not to say that it's exactly the same, but it reminds me of that period of time, probably back around 1998. Right before it started going up, and we looked at the .com and internet back then. The masses, that was not a new technology. It's been around, it was around for decades at that time. But what happened is it started getting mass appeal, and then all of a sudden it became a hype, and there was a big hype, and they started using .com and all the business calls and .com and all the things, and that would make everything go crazy and make interest, and you could raise a lot of money. In that sense, that's how I look at AI today. It's a lot of hype. We do not know what this stuff is, what this is going to end up being yet. not yet. Just like back in 1998, we weren't really sure where this could go. It was just, it's a game changer in 1998. And if you're not doing it, you're out. And it's going to change everything, you know. And at the end of the day, it did some stuff, but it also did in others. And we've evolved and we learned.
Wait, are
look
you
at
talking
AI
about
kind of-
crypto? Are you talking about crypto or AI?
No, AI, just AI. So AI, guys, AI, this marketing term of AI is machine learning, learning language models, LLM, neural networks. These are things that have been around for a long time. You know, in urban, we built a neural network AI. That's what powers our comps tool. That's what we have. We have an AI powered pricing tool for you guys. We just, you know, we don't really market it as AI. We probably will very soon. I'll tell you that, because of the hype of what's going on.
Yeah.
Ooh, AI, but it's overhyped. We don't know yet what it's going to be, but I guarantee you in 10, 12 months from now, there's going to be 500 companies doing the same kind of a stuff. Just like the .com era was, you're going to have a lot of people. So what floats to the top? I have no idea. Until then, there's a lot of really cool applications of AI, but I just think the hype is a little too much. And it saves a lot of time and it gives a lot of creativity. If I was a designer, I'd be worried. Yeah.
Well, here's where you and I part ways.
Yeah.
I actually don't think it's overhyped.
Yeah, that's okay.
I really think that there's very big things coming. And you know, my point was really more about the stock market and how much value creation there's been. You know, versus
reminds me of the .com. It reminds me of the .com period a lot.
So you don't think that value creation sustains?
No.
Okay. And to me, really, my point is, you know, with respect to New York or even San Francisco and some other markets, whereas on the one hand, you know, commercial real estate has taken and will take a big hit. Is there value creation in some other areas that offsets it? Right. So that's kind of my point.
Yeah.
And,
Right,
you know,
like another
ultimately-
Silicon Alley
Right.
sort of.
So there's going to be a lot of companies in Manhattan and in Brooklyn that will pop up, and there's going to be a lot of new talent coming into the city for these things, not only from Google and the big and you know Facebook and the big companies, but lots of smaller companies that will fill in a lot of these pieces, and that will also you know bring things up again.
Yeah.
Right.
While things are getting upset. So whether or not, you know, you and I agree on some of the kind of more macro things, I think there's some very positive things that are just starting to take place in that sector.
Well,
Yeah.
it's nice.
So
Oh, go ahead.
no, I was just going to really quick. I was just going to say, so if you think of the .com back in 1998, like eventually it did kind of become it was a game changer. I do think AI is going to be a very big game changer. I just don't think we know how, in what capacities, in what ways, in adoption, user adoption, in government regulatory ways. We have no idea how all of this is going to interplay over the next 5 years. And I think it's going to be a wild 5 years. And we're just kind of at the top of that euphoria right now. That's all I'm saying.
Gotcha.
Yeah, I think to Kael's
Yes.
point though,
Yep.
is, you know, if you look at it in the context of our audience and, you know, the connection to real estate, I think what it says is that the sort of the tech sector that has been very important, sort of almost supplanted Wall Street to a certain degree once they became, you know, the regulatory overlay after the financial crisis sort of, you know, reduced a little bit of moral hazard. I think that, you know, this is sort of an extension of like the tech boom that the city will benefit from, whatever form it takes. Like, you know, I whether it's work from home or, you know, whatever, you know, it's nice to see the city as one of these places that, you know, this kind of thing can really grow.
Yeah, that's kind of my point. You know, so yes, these offices are going to take a big hit. Yes, people are working from home, but this is a very potentially very positive input into the economy for New York.
Yeah, no, I totally agree. And
it's just starting.
Well, as my grandfather said when I was a kid growing up in Washington, D.C., he said, if you're not living in New York, then you're just camping out. So,
Nikki, should we go to questions at this point or in our last few minutes here?
Yeah, absolutely. If anybody has any questions, you raise your hands, put it in the chat.
All right.
See a few questions in the chat. I haven't reviewed them yet.
Hold on, let me open the chat here. We've got some.
Mindy was talking about federal agencies have already begun providing guidance to banks supporting the commercial sector. It's like they're setting it up, right, Mindy?
Yeah.
I mean, it's like they're setting everything up so that when that wave comes, that they'll be able to absorb whatever. I don't think it's. I think it's going to come and go. I don't think it's going to be as big as everyone thinks it might be.
Yeah, I'm not positive. I agree. But it sort of started already quietly in the last week or two, and you already saw some of the directives coming out of the agencies regarding cooperation and support and flexibility, all of those buzzwords, right? Which are basically the beginning of strong arming financial institutions potentially down the road to actually refinance. Because, as I said in the prior comment, it's really important to remember that the duration of the loans in the commercial market are, 5 years, for example, right?
Yeah.
So there's constant refinancing, and already there's, lots of people who have already started to default or potentially default, right? And are still in the process of early workout.
Yeah, it's like it's coming. You could see it, and it's just I just wonder, is it going to become a systemic thing, and they're going to start really, a contagion thing, or is it going to come and go? It's just dying to know what's going to happen.
Yeah.
The other really important part of it is just that, there are certain markets in the U.S. Let's just keep it to the U.S. for a moment, right? And New York is one of them. There are 2 or 3 principal markets, right, on the commercial side that will really either bear the brunt of, of this kind of sort of, semi-apocalypse or will not. It's not going to be sort of broadly disseminated and felt everywhere throughout the country. I think that's an important point. There's a lot of concentration in, particularly when we're talking about the office market.
Yeah, also the lending of those properties was not anything like, the lending quality, the underwriting quality wasn't anything like what we saw during the housing bubble, where you just had to have a pulse or fog and mirror to get a mortgage. And so that's why I don't think this is as far reaching. But everybody's right, is correct to be concerned, because we don't want this. But I don't think it's a reason to panic.
I agree.
Yeah.
And Robin was saying that she's read that banks' capital requirements are increasing, so maybe they're just starting to tighten up a little bit and just get ready. And what's that effect on us? It's just, again, right, a little tighter lending standards, right?
Right. They were talking about that with the regional banks, with SVB and First Republic. After that, sort of the mid-sized large regionals, boosting capital requirements, doing other things, like just to keep this from sort of spreading, and it didn't spread.
Could we just say something?
Yeah.
Where was rates, Kael? Where was rates 3 years ago
Compared to today?
Well, where was it 3 years ago? Yeah.
We're going to bring up your chart.
I don't even know. Zero? It says zero, right? Zero.
Yeah.
Real rate.
Zero.
Right.
All right, so zero, right? So the mortgage, we're up at 5.5. We're up close to 5.25 Fed funds rate, and went from 3% mortgages to 7%. Look at how our markets handled that.
Yeah.
Could I, if we said that, if we had this conversation when we had 3% mortgages 3 years ago, and what happens, Jonathan Miller, if mortgage rates go to 7%? What would you say?
Well,
Right.
I would have.
I mean, like in all honesty, would you have said prices would have gone down?
Yeah, I would have said, I don't think if it was before the pandemic, I would have said, we're going to see some, having gone through a few cycles, we would definitely see price declines much more significant than what we've seen now, which is like mid-single digits. But the variable this time was literally inventory. Like, and I think
Yeah.
it's the simple fact that the Fed kept rates too low for too long. I remember, like 3 or 4 months into the pandemic, I was saying publicly, like, rates need to be in the fives, or, that this is insane. And what we learned is that low rates can actually make housing less affordable, right? And because it obliterates inventory. Inventory can't be created as fast as demand can. So anyway, it's just been, who would have thought that this would be the look. Yeah.
Kael, I mean, what do you think on that really quick? I mean, like, would you have predicted that the prices would have fell from 3 to 7 mortgages?
Yeah, of course. But, I mean, as we've talked about with the inventory side, it's a constraint that, none of us saw coming. When you add in the lack of new inventory and the spread in the bid and the ask, it changes the equation more than we could have predicted back then.
Yeah. And Jonathan's point is yeah, I was just going to plug your point. Everyone has 3-4% mortgages. Everyone has 3-4% mortgages. Where are they going to go?
You're locked in place.
70% of people with mortgages in the US have a mortgage less than 4%, 70%.
Very expensive to move out of something like that.
Yeah. So it's time
for,
yeah.
Well,
people become less wedded to their rate, and their other needs take over, and more understanding about alternative products. Like I said before, a 5-1, a 7-1, a 10-1, which is how in more times than not, the market was behaving when we didn't have rates at the bottom, right? So people get comfortable with that. It just takes a little time, and it's hard to get comfortable when every month or a month or so we have another increase from the FOMC. Yeah. So
40%. I'm sorry, 40-year mortgages, Jonathan. 40-year.
I'm sorry, you froze on me. What did you say about
40 or 50-year mortgages coming soon?
Oh, you might see longer term mortgage. You might see some of that, but I think that if we do, it's going to be on the margin. It's not going to be a standard. I would be surprised if that really took hold. I don't think people are that desperate because there are alternatives. And that to me ends badly. I just can't see that being a successful direction to go.
Have you seen moving in that direction, Noah, in any way?
I don't know, but I'm just I mean, if the Fed has to keep rates higher or has to keep going higher, I mean, we're saying if right, nothing breaks and we keep going strong. And I mean, what if mortgage rates go to 7.5 or 8%, or they have to go to 8.5%? I mean, I'm just saying it's not out of the realm of possibility. What happens, and if it kills the whole housing market as a result? Well, A, is that what the Fed wants, and B, does the private sector react by giving a 40-year mortgage at 6.5%?
Right. Well,
as an innovative
home builders can do that, right? And they're already doing that right now. They're offering 5.5% mortgages, not in Manhattan specifically, but just around the country. You're already seeing that in markets where there's enough new product to that's actually, we have some markets that we see where literally the market is 50-50 existing and new construction, and the new construction is offering financing deals, which then just makes it more competitive with the existing product.
That's a really good point, Jonathan, because new builders have a lot of what's that word I should use? Incentives they could offer, financing incentives, and they're like a bank in and of themselves almost, and they can give things that resale people just can't give.
Correct.
It's a thing out there.
Right, because they can do it in scale. And so in these periods, you see this sort of, you see more creative sort of financing solutions come out of the woodwork, even simple ones like getting a 10-1 instead of a 30-year fixed or whatever. We've seen this before. It's not new.
That brings up an interesting question for a retail buyer of how to play this. If you believe that the rates don't stay high for that long, that could move in the direction of a shorter term product.
Right.
I think that's what a lot of buyers are thinking. A lot of buyers right now are like, oh, I'll just take an ARM. And I don't think there's any big difference between ARMs and 30s, actually. I don't know, but I don't think that there are. And I'll take an ARM. And then in 3 years from now, when rates are back down to 2 or 3%, I'll just refinance into the 30. And again, what if that doesn't happen?
Well,
Because
I don't think it's gonna happen. Like rates aren't going to go to 2 or 3%.
Unless something breaks. And if something breaks, then you're not going to probably want to buy something.
Right.
If they have to cut rates all the way down to 2% again.
Yeah, two of my sons just bought houses, and like that's exactly what they said. They said, "Well, we got to, we have a 30-year, but we can afford it. We qualify for it. But like in 2 or 3 years, we'll refi and at a lower rate." And I thought, yeah, probably 2 or 3 years from now, rates might be a little bit lower, but they're not going to be half of what they are now. But I could be wrong, who knows in this world. But it just doesn't seem like a good bet to me.
We're running out of time, but I see that Mindy has her hand up. Mindy?
Yeah, a couple of things. First of all, it is true that developers, even in Manhattan, have offered incentive financing or incentivized financing, like buy downs, right? Rate buy downs. Also, just a note that for the first time in ages, we have seen banks putting points on their mortgages in New York City. And basically, that's just another way of sort of, bringing down the rates. And those are published, sort of published buy downs with points. But, the banks are pretty negotiable these days. If you go to the bank and you say, I have a relationship with you and you're saying that I can, buy down, I can buy down, I don't know, 7/8 of a point or something like that, right? Or I can use discount points. If you go to them and you say, I'm not going to do this, unless you give me a better deal up front, the banks are dealing for sure, because their business is way down and they have absolutely no refi business, period.
Right.
Dead in the water. Right.
Interesting.
Yeah, the other thing I would say is we haven't talked about this in a long, long time, but I started this year talking to my clients who were buying, who are selling, and asking them to look at their mortgages and see if there was any clause for assumability in mortgages.
Right.
Yep. Because nobody has talked about it for like 10 years, right? Because rates only moved in one direction.
Yeah, for sure.
But everyone sort of forgot that there were things,
You're transferring mortgage with the sale.
Right. Mm-hmm.
Yeah.
And sometimes sometimes assumability is not at the exact rate that you have or the exact terms, but it's somewhere, it's sort of like a SEMA. It's somewhere between, the new rate, right, or the current market rate and what you have in your, in your existing loan.
Yep.
So I would say that even on resales, that is a really good thing to ask your sellers about, if they have financing on their properties.
Right.
Yeah, Robin's saying there's not too many of those out there. I wonder how many of those are out there. Interesting question.
Yeah, I mean, I found a few right so far, so it's worth the question. Awesome. Right? And it's worth people.
How much is that worth? What is that like? Is that like, so like if you sell $1 million property and you didn't have that option versus $1 million property that does have that option, how much is that worth, you think?
So it depends on what the optionality is, right? Is it the existing rate in the loan, right? And is there some expense? Sometimes there's a flat expense for assuming, right? And sometimes there's just some kind of sort of interim rate, right? That is, as I said, not as favorable as the original rate, but also not as unfavorable as the prevailing market rate.
Gotcha.
Mm-hmm. It's very individual.
Right.
And even a lot of mortgage brokers and bankers don't even talk about it or don't even know about it. They don't even think about it because it just hasn't been an issue for so long. It hasn't even been,
right.
The environment didn't warrant it.
No.
Exactly. Mm-hmm.
Yeah. No, it all speaks to the creativity that you're going to see come out of the woodwork going forward through brokers like yourself finding ways, and the consumer just becoming more sort of educated that the 30-year fixed is not the be all to end all forever, which it has been.
Yeah, I mean, I had this conversation yesterday with somebody, actually a friend of mine who was refinancing because she, for some reason, I don't know why, got a balloon mortgage the last time she refinanced. And so I was like, why did you do that? I mean, on a residence, like it's just almost unheard of in New York City, but she did. She said to me that she is in a position where she's gonna have to owe 7 figures in September if she doesn't refi. So her mortgage person is saying, oh, we should definitely get a 30-year fixed, right? And I said to, and because of course it's the best deal for the bank, right?
Sure.
So right. So I said to her,
Biggest
well,
fees.
yeah, she's almost retiring. And I was like, why wouldn't you take a 10, for example, where there's almost no risk to you at this point? You could definitely maybe be selling your apartment before 10 years. At some point in the next 10 years, there's going to be a moment where rates are lower than they are now. That's your risk. Your risk is there not going to be any moment in the next 10 years where rates are lower than they are now if
Right.
you're holding on to your apartment for another 10 years at this stage of your life, right?
Sure.
So you really do need to look at that.
We're running out of time, and I just wanted to make sure before people start hopping off that you remember that we're having our halftime with NYRS on August 9th. The guests have not yet been announced. That'll be 9 o'clock in the morning with a hard stop at 10. For our guests, I'll just say NYRS has started this year creating these halftime reports halfway through a quarter with a few experts who are NYRS who kind of say what's happened since the last time what are they noticing that has changed since everyone's quarterly reports came out, because that was something that we saw was missing because things would move so quickly. So that's coming up again on August 9th at 9 o'clock. And we will be sending out information and saying who our guests will be. And if you gentlemen want to show up, just let us know. And other than that, I think we need to go and just say thank you so much to Kael, to Jonathan, and to Noah for being here with us today and imparting your wisdom. And we will talk to you again soon. So thank you everyone for coming, and thank you,
Julie. Thank you, Nikki.
Yeah, thanks for having us.
Thank you, Julie. Thank you, Nikki. Thanks for being here. Thanks, guys.
Thanks, everybody.
Thanks, everyone.
Bye-bye,
Have a
everybody.
good
See you all
one.
soon. Bye.